Are you making one or more of the 5 deadliest mistakes that options traders make without knowing it? Any one of these mistakes can end up blowing your whole trading account. So this is a video you'll want to watch very closely if you trade options. I'm Seth Freiberg, and we're one of the top proprietary trading firms in the world with numerous 7 and even 8-figure per year traders. You found the right place to learn. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. And we've trained hundreds and hundreds of options traders over the years. And that gives all of you watching this video a really big advantage, because if you take this video to heart and accept that what we're sharing with you today comes from years of experience and years of watching promising traders who had a lot of potential just blow up because they fell into one of the 5 traps that we're going to be sharing with you today. If you take this advice seriously, it gives you a huge advantage. And I implore you to take these ideas seriously, because each one is on its own deadly. Options income trading can have a really high win rate and can provide exceptional returns. And so it's especially tragic that so many traders fall into these traps and never get to experience those win rates and returns because they blew up their accounts before they had the opportunity to become consistently profitable traders. Okay, so let's get into it. So some of you may not be aware of this, but there are certain options income strategies that have an extremely high win rate. One of the strategies that I personally trade, the Rhino, has a historical win rate of 80%. And so I expect to win these trades most of the time. But I also have been trading long enough to know that if you have an 80% win rate, you also have a 20% loss rate. And so losses are inevitable. And furthermore, with such high win rates, it's actually pretty easy to get on a winning streak that almost makes you feel invincible. And believe it or not, that feeling of invincibility is actually one of the most dangerous feelings that a winning trader can have. I was mentoring a student once who was on such a winning streak. He had traded a strategy known as the credit spread, which, depending upon how you trade it, can have an extremely high win rate. And he was on a winning streak of 10 or more credit spread trades in a row. And that's not at all uncommon, really. And so in one of our mentoring sessions, this student said to me, "You know, Seth, credit spreads are an ATM machine that just keeps spewing out money to me." And my response to him was, "I forbid you from ever uttering those words again in your life. First of all, when you say things like that, you're angering the options gods, and you will be hit by a lightning bolt shortly thereafter. But in seriousness, more importantly, what you're saying is utterly ridiculous. If you were right, then everybody would quit their jobs and just trade credit spreads all day. But in fact, there is no trading strategy in the world that wins 100% of the time, and no strategy in the world that just automatically spits out cash to you each week or each month or whatever. Would you call it an ATM machine if instead of it dispensing cash to you each week, it began to reach into your wallet and take your cash out of it? Because that's what a trading loss actually is. And trading losses are inevitable and sometimes frequent. And if you think of any strategy as an ATM machine, you are in literally the worst possible mindset for being a trader. Why? Well, think about it. If you believe your strategy is an ATM machine and either wins all of the time or will win most of the time, then you would be crazy to not sell all of your possessions, mortgage your house, take loans from every relative, and just stick every penny you have into your trading account to trade as large as you can to make as much money as you can. I mean, after all, if you're making a 30% return on $10,000, you'd make $300,000 on a $1 million account. Now, that's just logical, right? Which brings us to the first deadly mistake that options traders make. Unfortunately, there's a flaw in thinking like this, and that flaw is so large and so dangerous that you may well blow up your account and never get a chance to experience excellent returns. I'll give you a vivid example of this. And so over the years, I've observed that options income trading strategies have a tendency over the long term to yield about a 30% return on any given year's utilized capital. But that assumes that you'll use the same amount of capital each month. Well, let me tell you a real life story. The facts are altered a little slightly, but it's in the ballpark of what actually happened. A certain trader I know was utilizing a particular options income strategy, And he was initially trading a $25,000 account as a kind of experiment with a long-term plan of contributing heavily to the account up to $500,000 of his own capital initially. And so what happened was he experienced very close to the following experience in his first 5 months of trading this strategy. And so he thought to himself, what an idiot I've been. I traded such a lame level for so many months now, and I'm up 22% in 5 months with a 100% win rate. And so this is just too easy. I might as well put all of my chips in now. And so he put his entire $500,000 in capital into his account at once. And I'm guessing you kind of know how this turned out, because in June, the completely predictable and inevitable first loss came. And here's what happened. Remember, the first month where there was a loss was June. And it just seems to always work out this way, that if you irresponsibly and radically increase your capital level based on a short winning streak, it's almost as though the market is just sitting there waiting for you to make this mistake so that it can pounce and deliver the knockout blow to your trading account. And so by increasing his capital to $500,000, he took what would have been a winning 6 months into a catastrophe, where he gave up every penny he had made up to that point and managed to lose an additional $29,000 on top of that. Trust me, after having an experience like that, most traders just say, well, trading's not for me. And they go out and find a job that they might, in fact, hate and never really allow themselves a chance to actually succeed. Whereas if he had been sensible about it and just kept his capital level at the same level all year and then judiciously increased it the next year, he would have instead had this experience, gaining 30%, up $7,500, and in a position to increase his capital, say 20% the next year, so that no one loss can knock him out of the game psychologically, but instead he builds up his risk tolerance slowly, so that the large dollar losses from the occasional losses in the next year will be matched with larger wins, which allows him to be able to build his account and his trading career sensibly, instead of blowing up your account by going too far, too fast with your capital. So I implore you to avoid this pitfall and give yourself a chance to become a full-time professional trader. The next huge mistake that beginner options traders make is to use market orders instead of limit orders on options trades. You see, most options income strategies involve buying and selling options at the same time for reasons we've explained in other videos. But for the moment, just accept that these multi-legged spread orders are a mainstream practice for options traders all over the world. And so just like any other security, every option has a bid and an ask, and sometimes they can be very far apart. And so let's say one day you decided you want to enter into a 10-lot options trade on the NDX index, the NASDAQ 100 index, and you decided to buy and sell the options on this slide, which happens to be a strategy known as the iron butterfly. Well, and these are real-world numbers. Each of the options has a bid price and an ask price, and the average of those two, which is known as the mid price. And so what professional options traders do is that they execute the trades at the mid price. And remember, we're both buying and selling options simultaneously. So the buying of an option represents cash outflow, and the selling of an option represents cash inflow to your account. And so if you now break down what's happened cash flow wise, you'll see that, for instance, for the 11,775 call you sold, you multiply that by 100, because all options prices are multiplied by 100, to calculate how much you'll be receiving by selling that option. And you sold 10 of them in this example, so you multiply it by 10. And so multiplying it all together, you received in this example $534,740 for selling that first option. And using that same logic, selling the next option listed brings in over $458,000. And then, as you can see, the next two entries are buying options. And when you add it all up, you end up receiving a net of $140,850 for entering into this trade, because the cash you received for selling the options is less than the cash you paid out for buying the options in this example. And this is very common when initiating spread positions with options. And you'll note at the bottom of the slide that your broker will require you to have in your account $9,150 for this trade, which is the worst loss you can suffer on the trade. And the broker's calculation is based on a number of things, but one of the larger issues is the amount of cash that you brought in initially for the trade. And so the less you bring in up front, the more the broker will require in terms of capital for this kind of options trade. And when you enter into this trade, there is the possibility, not super likely, but the possibility of the trade ending up so that you make on the trade all of that upfront cash flow, which would be the perfect trade, which is rare, but it does occasionally happen. And so in this case, the maximum reward to the maximum risk on the trade, as you can see from the calculation, is 15.39 to 1, which is obviously a great risk reward. And so exiting trades at the mid is done by placing with your broker what is known as a limit order, executed at mid prices. But let's look at what happens if instead of that you put in what's called a market order for the same spread. Well, the problem with a market order is that you don't get the mid price for any of the options, whether you're buying or selling them. Rather, you get the lowest price if you're selling it, and you pay the highest price if you're buying it, because that's the way market orders work. You sell things at the cheapest price the market's offering, and you buy them at the highest price the market's offering. And so the result is that you're obviously getting a much worse execution. And as you can see from this calculation, the results can be drastic. Because in this case, we paid much more for each option we bought, and we sold each option for much less, so that in this case, we received more than $10,000 less for the spread. And making matters worse, remember, one of the factors your broker considers is how much you received for entering the spread in the first place. And that was so much less in this case, then as you can see, the broker is now requiring more than double what you were requiring to put up for the limit order. And so just look how drastically the two different trades are. With the limit order, you bring in $10,000 more. Your broker requires less than $10,000 for you to execute the trade, and your risk reward is more than 15 to 1. Whereas with the market order, you bring in $10,000 less, you have to put up more than twice what the limit order required, and your risk reward is less than half of what was the case with the limit order. And yet, most options trades get executed at or near their mid prices, and so just by choosing the wrong order type, you cost yourself a fortune over the years. So this is a huge and easily correctable mistake if you listen to this advice. The next deadly mistake is what we call strategy hopping, and it goes something like this. Let's take a look at that strategy we were talking about earlier, which had this pattern of returns in a particular year. We'll call this strategy A. Now let's move back to when the trader had traded this strategy through August. And even though he ended up the year with a series of break-even or winning months, culminating in a 30% return, through August, he would have had 5 wins in a row, and then 3 months in a row where he lost money or broke even. And many traders at this point make this fatal mistake, which is to say to themselves, hey, there must be something wrong here. My strategy isn't working. It must have broken down. It's lost money in the last 3 months. And even though in reality he experienced a very predictable and pretty mild drawdown, he falls prey to what we call recency bias, which is the tendency to generalize the experience you just had as opposed to broadening out your thinking to the big picture, long-range time horizon. So to illustrate how this mistake works, let's take a look at a different strategy, which has the exact same outcome, but the results over the 12-month period take place in a different order and a different magnitude per trade. And we'll call this strategy B. And so if you look at the full year, you can see it had the exact same return, 30%. But if you were only looking the first 8 months and you had compared the two strategies, this is what you'd see. And if you're a strategy hopper trading strategy A, you'd see that, hey, in June, July, and August, I lost money, while my friend who's trading strategy B, he just had 3 great winning months. I must be some kind of an idiot to keep trading my strategy when he has made so much more money in the last 3 months. And so he hops over to strategy B and trades that for the rest of the year. And so what's the result? Well, let's take a look at that. And as you can see, you would have been just as well off if you had simply stuck with strategy A or strategy B, where you would have, in either case, had a 30% return. But by falling prey to the recency bias and moving to strategy B after 3 months where you made no money on strategy A, you walk right into the period where strategy B starts to underperform, causing your return for the year to fall off a cliff to 4%. Look, if you've done your due diligence on a strategy and back-tested it extensively, and you know that it goes through down periods, why lose faith in the strategy when you haven't even allowed it to play out even over a year? I can't tell you how many times I've seen traders fall into this trap, and as you can see, it can be devastating to your returns. Now, the next deadly mistake is where traders fall into the trap of buying cheap, way out of the money options. Now, to illustrate this example, let's take a look at General Mills stock with the trading symbol of GIS. And in July of 2022, it was trading around 75, as you can see, closing at 74.92 on July 15th, the day the July monthly options expire. And so if a trader was bullish on General Mills, he could have bought 10 of the September GIS 85 monthly call options, which were going for only 13 cents. And as most of you probably know, a call option on a stock entitles the buyer of that option to buy 100 shares of the stock for the strike price of the call option, which in this case is the 85 call option, at any time between the time you buy it and the call expires. And since you get to buy 100 shares of the stock per options contract that you buy, you multiply that 13-cent premium times 100, and since you're buying 10 of them, you multiply that by 10. So the total cost of the call options is actually $130 for the right to buy 1,000 shares of GIS at 85 in 2 months. So that's not much risk, because the worst case scenario is that the calls expire worthless, GIS never reaches 85, and you just lose your $130. Now, I'd like you to focus on the fact that on this options chain, there's a figure called the delta of the option. And as you can see, the calls we bought had a delta of 2.76. Well, statistically, what that means is that there's roughly 97.24% chance that those options will expire with no value, worthless. Or putting it another way, there's only a 2.76% chance that the option has any value at expiration. And in fact, on September 16th, when these options expired, GIS did indeed close way below 85, down at 75.25, which means that the call options expire completely worthless, because no one is going to exercise their right to buy GIS at 85 when the stock can be bought in the open market for 75.25, obviously. And is that any surprise? The option, when we entered into it, had more than a 97% chance of expiring worthless. So should we be surprised that the options did what they were predicted to do 97 times out of 100? I mean, did you ever hear the expression, cheap is cheap? Well, keep that in mind next time you're considering buying a far out of the money call or put. If you don't check the delta of the call or put and realize you're throwing your money away more than 97% of the time in this example, then you're being pretty foolish. There's no point in throwing your money away on options that have a minuscule chance of having any value. But believe me, the traders who sell you those options are more than happy to take your money. Okay, and finally, there's the last deadly mistake, and that is the assumption that because you have backtested a strategy, that your results will be the same as the returns you gleaned from your backtest. And I can tell you from experience that that is almost never the case, and that your returns will be worse than your backtesting results pretty much all the time. Now, why is that? Well, here are a number of factors that contribute to this, and one of the most obvious ones is the fact that no matter how experienced you are, you're going to make execution errors. You mean to buy an option, but instead you sell it, or you intended to buy 10 options, but you accidentally buy 100. And the problem with execution errors is that once you make it, you've got to immediately reverse it, which almost always means that you'll take a hit on that reversal, having to pay up to get out of the position you mistakenly entered. Plus, you have the cost of the commissions of mistakenly entering the trade and then exiting. All of this delays your entering the correct trade, which in many cases will cause you to get less favorable terms on the trade you wanted to make in the first place. In short, execution errors suck, and it downwardly affects your returns in almost all cases. The second reason is that backtests are usually performed assuming you will achieve mid prices on each trade. In other words, halfway between the bid and the ask. But in fact, in many cases, you'll have to pay a little more for an option you're buying, or collect a little less for an option you're selling. And these nickels and dimes start to add up if you're trading in any kind of size over any kind of a period of time. And this phenomenon is known as slippage, and it has a real effect on trading results. Next, you'd be surprised how many traders conduct backtests and forget to include commissions in their results. That's pretty much an inexcusable oversight, but if you're not careful and deliberate, your backtest results could be way off when you include the effect of the commissions. The next issue is a subtle one that most people miss, and that is when you backtest the strategy, the only trade you're focusing on during the backtest is the strategy you're testing, obviously. But in the real world, you may have other trades on And in a big market move, you may have to deal with all of the trades you have on at the same time, meaning that in order to exit one trade that you're getting stopped out on, by definition, you're ignoring your other trades for the time being, which has the effect of causing you to blow through your stop in certain cases, which in a backtest would not ever have happened because you're focusing exclusively on that one trade that you're researching, and therefore will always exit the trades according to the prescribed rules of the trade. So this phenomenon will downwardly affect your results in many cases. And finally, and perhaps most importantly, traders are not robots. They're real human beings with real emotions. And the importance of that is that when you're trading, you may get either greedy or scared and make a move on a trade that is not in keeping with the strategy that you were testing. And in most cases, this deviation from your trading strategy is going to be detrimental. And so by definition, you're not actually trading the strategy you tested. And so of course, you're going to have a different result. And honestly, in most cases, that deviation is going to hurt you and hurt your annual returns. Now, the good news is that as you gain more experience, you'll learn to cut down on each of these factors, and your backtest results will more closely resemble your live results, but it's rarely going to turn out just as good as your backtest. There will be some degradation because of these 5 factors, even if it's minor. And so today's video is about the realities of trading and challenges that you face as a trader, especially beginning traders. And the great part is that I and basically every other professional trader has made every one of these deadly mistakes. And believe me, they become embedded in your memory as painful experiences that you learn very quickly you don't want to ever experience again. So now it's up to you. You can take this advice, which I guarantee you will save you a great deal of money, or you can ignore it and make all of these mistakes, which I assure you is a much more painful and expensive way to go. Like anything else in life, it pays to listen to people who've been through painful experiences. Wise people and wise traders avoid these mistakes, which only will accelerate your growth as a trader.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of SMB Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part, you don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.